How familiar are you with bonds? Maybe you know coupon payments and maturity dates, but are you ready to go deeper? Today we'll briefly review the basics, then dive into corporate bonds, going beyond the mechanics and into how to actually find and invest in bonds that fit your goals. These concepts are essential if you want to manage your fixed income investments with more precision. Corporate bonds offer a unique blend of income and stability, somewhere between the volatility of stocks and the safety of cash. If you're looking to build a truly well-balanced portfolio, understanding corporate bonds is key. Let's get started. So, what exactly is a corporate bond? When you buy one, you're lending money to a company. In return, they agree to pay you regular interest, called coupon payments, and repay your principal when the bond matures. You may also hear terms like face or par value. They all refer to the same thing, your original investment. Now here's something important. Bondholders have a higher claim on the company's assets than stockholders. So in a bankruptcy, they get paid first. That said, bonds are not risk-free. We'll get to those risks shortly. But in general, corporate bonds are less risky than a company stock. Let's look at a quick example. You buy a bond at par, say $1,000 with a 4% coupon, and you hold it to maturity. Your return, 4%. Easy. But it gets trickier when the price is above or below par. That's where YTM, or yield to maturity, comes in. YTM comes in to factor both the price you pay and the interest you receive to show you true annualized returns. Buy below par and your YTM is higher than the coupon. Buy above par, it's lower. That's why YTM is often more relevant than price when comparing bonds. Whether you know what you're looking for or just want to browse, start by going to the bonds section of our app. You'll see a yield chart that helps you compare yields across different maturities and asset classes like US Treasuries, investment-grade corporate bonds, and junk bonds. Got something specific in mind? Use our advanced search, one of the most powerful mobile bond platforms on the market. Just browsing? Check out our preset list and popular company section to get a feel for the bond landscape. Let's talk about key risks: credit risk, interest rate risk, and call risk. Credit risk means the issuer might not repay, so always check the credit rating, from AAA to C. On Webull, you can filter for investment grade if you want more safety, or high yield if you're open to more risk or potential return. But keep in mind, higher yield usually means higher risk. And here's something else. When interest rates rise, bond prices typically fall, especially for long-term bonds. But here's the upside. If you hold a bond to maturity, you'll still get your full principal back, assuming no default. The risk only becomes a loss if you sell early when prices are down. Another key concept, call risk. Some bonds can be paid off early by the issuer, usually at face value. If you paid a premium, that early call means a lower return. So when comparing bonds, look both at YTM and YTW. That's yield to worst, or the lowest possible return if the bond gets called early. So, how do you invest in corporate bonds effectively? One word: diversification. You can diversify in several ways: by issuer and sector, spread across different companies and industries, by credit quality, mix safe investment grade with some higher yield exposure, by maturity, hold short, medium, and long-term bonds to manage rate risk. And when it comes to strategy, you've got three core options. First, the buy and hold approach. Buy the bond, hold it to maturity, and lock in your yield. It's simple and great for principal safety. Second, active management. Buying and selling based on interest rate or credit expectations. This can offer higher returns, but comes with a lot more effort and potential risk. Third, the bond ladder. Buy a mix of bonds that mature at regular intervals, say 1 to 5 years. As each bond matures, reinvest at the new rate. If rates rise, you reinvest at higher yields. If they fall, vice versa, you can still earn those older, higher yields on your long-term bonds. It's a smart way to manage rate risk while keeping income flowing. Understanding these concepts, from types of yield to risk to strategy, helps you go beyond the basics. Corporate bonds can be a powerful tool for diversification, stability, and income. Just make sure your bond strategy aligns with your financial goals and risk tolerance. To learn more about bond investing, diversification, stocks, and ETFs, check out Webull Learn. Whether you're a seasoned bond buyer or just starting to learn, our platform makes it easy to search, research, and invest in bonds. Thanks for watching. Don't forget to like and subscribe for more investment insights.